Most people think $1 million automatically guarantees financial freedom. But here's the surprising truth. Depending on how you invest it, $1 million can make you feel rich, barely comfortable, or shockingly stressed. Today, we're breaking down exactly how much income $1 million can produce in dividends, why the numbers vary so wildly, and how to build a portfolio that actually supports your life. Let's get started. Dividend income depends entirely on the yield of your portfolio. $1 million invested at a 3% yield gives you $30,000 a year. At 4%, you get $40,000. At 5%, $50,000. These small percentage changes completely reshape your lifestyle. The first step is understanding that dividend income is not guaranteed and is influenced by the sector, risk level, economic conditions, and payout strategy of the companies you choose. If you want to stabilize your income, diversify across multiple sectors rather than chasing the highest yield. Financials, utilities, consumer staples, telecom, and energy all behave differently during different parts of the economic cycle. Spread your million across at least 6 to 8 sectors to avoid depending on a single source. Your first actionable step is to identify your target dividend yield range and make sure your portfolio allocation realistically supports it. The 3% scenario, the conservative path. A 3% yield is typical for a conservative portfolio heavy in dividend aristocrats and broad market index funds. With $1 million, you would earn about $30,000 per year or $2,500 per month. This income level works best for retirees with other income sources such as Social Security, rental income, or a part-time job. If you choose this approach, your priority is capital preservation. The key step is to protect your principal by investing in companies with decades of stable payouts. Focus on low payout ratios, consistent earnings, and diversified revenue. Reinvest a portion of your dividends to hedge against inflation. Your main strategy here is slow growth, low volatility, and dependable income. The 4% scenario, the balanced income strategy. At a 4% yield, your $1 million produces $40,000 a year, or about $3,300 a month. This is the sweet spot many financial planners recommend. It balances the desire for income with the need for long-term growth. A balanced strategy includes dividend ETFs, blue-chip stocks, and some exposure to real estate through REITs. The actionable step for this level is to build a 3-tiered portfolio. Tier 1 holds stable dividend payers. Tier 2 contains moderate yield ETFs. Tier 3 includes growth companies that may increase dividends over time. This structure helps you maintain income today while building higher income for the future. A 5% yield gives you $50,000 a year. This is where income becomes more comfortable, but also more volatile. You'll likely need REITs, high-yield ETFs, covered call funds, and certain international dividend stocks to reach this level. Some investors love this approach because it creates meaningful cash flow without touching the principal. Your concrete step here is to analyze the sustainability of every yield above 4%. Anything over 5% requires caution. Look at payout ratios, debt levels, and dividend history. Never invest based solely on yield. Make sure every high-yield investment is supported by strong financials, consistent revenue, and a long-term business model. At this range, your income jumps dramatically. 6% yields $60,000 a year. 8% yields $80,000. Many people are attracted to the idea of making nearly $6,000 to $7,000 a month. But the catch is that high yields often collapse during downturns. Companies that pay 8% usually deal with slow growth, high debt, or unstable markets. If you choose this path, you must build a safety buffer. Hold at least 20% of your portfolio in safer, lower-yield assets. Use stop-loss rules and rebalance quarterly. This is not a set-and-forget portfolio. It requires active monitoring, frequent review of company fundamentals, and a willingness to adjust quickly as conditions change. Taxes can significantly reduce your real dividend income. In a taxable account, qualified dividends are taxed from 0 to 20%, depending on your bracket. Non-qualified dividends can be taxed much higher. If you invest through a tax-advantaged account like a Roth IRA, you can legally avoid paying taxes on your dividends altogether. Your actionable step is simple. Run the numbers on two scenarios, one where all dividends are taxed and one where they are sheltered inside a tax-advantaged account. The difference is often thousands of dollars a year. For many investors, the best strategy is to hold high-yield assets inside a Roth and lower-yield blue chips in taxable accounts. $1 million today is not what it was 20 years ago. Inflation slowly erodes the purchasing power of your dividend income. A 3% yield might be acceptable now, but in a high inflation environment, it becomes almost unlivable. Companies that regularly raise dividends help protect you from this erosion. The step here is to prioritize dividend growth stocks. These companies raise payouts annually. Choose firms with a history of 10 to 20 years of consistent increases. Over time, your dividend income grows faster than inflation, giving you more financial stability and long-term protection. Building a sustainable dividend portfolio means combining yield, stability, and growth. Too much focus on just yield may cause a collapse, while an emphasis only on safety leads to very low income. A true balance is found through diversification across industries, countries, and asset types. To achieve the right mix, combine blue-chip companies, real estate investment trusts, REITs, exchange-traded funds, ETFs, and a small allocation to carefully selected high-yield positions in your portfolio. Your actionable step is to build a written portfolio policy. Clearly define your target yield, your personal risk tolerance, your chosen asset mix, your rebalancing plan over time, and the criteria that will trigger you to sell certain investments. Most people fail because they invest emotionally. A written strategy prevents panic selling and forces you to make decisions with discipline and clarity rather than on impulse or fear. Many new investors expect their $1 million to fully replace a full-time income. But realistically, unless you take high risks, most portfolios generate between $30,000 to $50,000 a year. Dividends are often overestimated, and the true amount of capital needed for independence is underestimated. To build a solid plan, evaluate your lifestyle costs honestly. If you require $70,000 a year to live comfortably, you may need more than just $1 million or a secondary source of income. Make sure your expectations for passive income are realistic. The true power of dividends comes from time, consistency, and reinvestment. $1 million dividend portfolio rarely starts with $1 million. Usually it begins with a few $100s invested consistently, month after month, and grows over time. Your actionable step is to automate your investments. Set up a weekly or monthly contribution and stick to it. Make sure to reinvest all dividends until you reach your target income. Starting early accelerates the compounding of your wealth. Here's a straightforward allocation for sustainable dividend income. 35% dividend aristocrats, 25% dividend ETFs, 20% REITs, 10% international dividend stocks, and 10% high-yield tactical positions. Adjust these percentages in line with your risk tolerance and age. $1 million can generate anywhere from $30,000 to $80,000 in dividend income annually. This isn't luck. It's the outcome of how you allocate assets, your risk levels, and your discipline regarding taxes, diversification, and reinvestment. The financial freedom you want is possible, but you need to build a well-thought-out strategy. Avoid chasing the highest yields. You need a plan, not a gamble. A properly managed $1 million portfolio can support you for life. And tomorrow, we will talk about the S&P 500, shocking facts.